I'm Charles Harris, and I'm going to start us off by covering a number of technical sell signals that often occur when a stock is forming a top. And after I've gone through these 7 signals, I'm going to bring Mike and Amy back into the discussion, and we'll go through a couple of topping animations where we'll follow a stock on a day-by-day basis, and we'll describe how we would scale out of the stock based on the topping signals that I just covered. Now keep in mind that the sell signals that we're going to talk about are just a subset of a larger group of signals that we cover in some of our workshops. Now, before we get started, I should say that most investors find that selling is much more difficult than buying. It's pretty clear to determine where the proper buy point is when a stock is breaking out of a base. It's often not so obvious when it comes to selling a stock. But there are a number of indications and signposts that we've identified through our studies that typically occur when a stock is topping. So if you can recognize these signals and act on them, then you have a fair chance of exiting a position before the stock breaks down too badly and is far off its peak. Now, when we make a decision to buy a stock, we're always focusing on both the fundamentals and the technicals. But when it comes to selling, we're going to act on the technicals only, because most of the time a stock will peak and begin trending lower well before the fundamentals break down. So the chart is usually your best and earliest indicator that a stock might be topping. Now, most of the time a stock will flash a number of technical warning signs when it's in the process of topping. So one signal alone typically won't be enough information to exit your entire position. But as the evidence mounts and you see more clues, you should act on them by scaling out of your position as it becomes more apparent that the stock may be topping. So our goal isn't necessarily to try to get out at the high. We don't pretend that we're going to be able to top take the stock, but rather our goal is to get out as we recognize the warning signs and technical sell signals that often coincide with the top. So if you can manage to average out of the stock within 10% or so of its high, then you're doing really, really well. So let's begin with the first sell signal, and this is when a stock goes into new high ground on low volume. If the stock goes into new high ground on noticeably lighter than average volume, or volume that's clearly lighter than previous moves to new highs, then it's a clue that institutions aren't running the stock up. And since institutions dominate the market and are the driving force behind big stock moves, that lack of volume is indicating a lack of institutional involvement, and so that rally is suspect. So it's really important that the price action be confirmed by the volume action at these important points when a stock is clearing resistance and moving to new highs. So let's take a look at an example. This is Hollycorp, and now we're going back to 2007, and you can see the stock broke out of a cup with handle base, and then staged a really nice advance over the next 5 or 6 months. Now, we can see here that as the stock was moving into new high ground, look at the volume. Well below average as you're going into new high ground here. Now, by comparison, look at the volume when it was going into new high ground over here in the chart. You can see the heavy volume over here on 1, 2, 3 days moving into new highs. Even over here, as you're moving into new highs, you see the large volume bars. But here is conspicuously low. So what we're going to do is sell into that, scale out of our position as the stock is moving into new high ground on that light volume, because that's our indicator that we don't have institutional support there. Now again, we're going to scale out. I'm not going to suggest that you would dump your whole position because of this kind of action, because you never know what's going to happen. We didn't know the stock was going to roll over, so badly after this kind of low volume highs here, but it can happen. So perhaps you would scale out 10, 15%, maybe 20% of your position as you see this kind of action. The beauty of it is you're selling it offensively into new highs as opposed to waiting until the stock breaks down badly. So that's the new highs on low volume. Let's move on to the next one. So this is when a stock has a weak rebound rally, and typically this will be off of a moving average or other area of support. Now, healthy price and volume action occurs when a stock is advancing on relatively heavy volume, but pulls back on relatively lighter volume. So this type of price and volume action is indicating that the stock is under accumulation. But if the reverse happens, such that the stock moves down on heavy volume and then begins to move up on lighter volume, then it's suggesting that the stock is under distribution. So that would be a warning sign. If you see this kind of action occur, you want to sell at least some of your shares into the strength on the way up, because the presumption is that this low rebound on the downside. So again, this is an offensive way, selling into strength to get out of your part of your position. Let's take a look at an example. This is a stock called Thomas & Betts. You can see in the lower left of your screen, the stock formed a double bottom base and then staged a huge gap up here, well above the pivot point, which was around 35, and had a really nice long advance, more nearly doubling, maybe going up about 80% from the mid-30s up to $61. And you can see here, I'm going to zoom in on the top. The stock comes down to the 50-day moving average here. And you can see we've got 1, 2, 3, 4, 5, about 5 days of heavy volume or above average volume on the way down to the 50. Now, volume on the way back up, you had a couple of above average or heavier volume days, but in comparison to how the stock came down toward the 50, this was a relatively lighter volume bounce toward new highs. So as you notice that this volume isn't what you'd like to see, in fact, you can also compare it to volume a little further to the left here. When we're coming off the 50-day down here, you see volume really beginning to pick up and really getting heavy as you're moving to new highs. Here it's just much lower than that, again, lower than how you came down to the 50. And you can see that the stock resolved by, again, falling. And look at how the volume picked up as you began to move back down. So again, here's your weak rebound rally, and you can sell into that as you recognize that volume really isn't as heavy as you'd like to see it. Let's move on to the next sell signal, and this is when a stock breaks below the 50-day moving average in a decisive way. And this has always been one of my favorite sell indicators because the 50-day moving average line will sometimes contain the stock's entire advance right to the very top of the move. So if you've got the right stock and you have the patience and the discipline to stick with it until that 50-day moving average is decisively broken, then you may be able to write out the stock for a really huge gain. Now, when stocks are in uptrends, the 50-day moving average line will often act as an area of support because institutions like to buy on pullbacks in order to keep their average costs low. You have to remember that big institutions have many, many billions of dollars to deploy. They can't always buy stocks when they're moving up because they'll run their average costs too high. So they take advantage of pullbacks and weakness in order to add to their positions, and that 50-day moving average is typically one of those areas where they step up to the plate and support their stocks. Sometimes a stock will break below the 50-day moving average in a relatively minor way for just 1 or 2 days before coming back above. So we call that a shakeout because it scares a lot of people out of the stock. You know, it can be very scary when you break below that 50-day. Now, if the stock does not find support at the 50-day, but rather decisively breaks below it, particularly if it's on heavy volume, then that is a very serious warning sign. And this is especially the case if the stock found support at the 50-day on previous pullbacks. So you know, this kind of action would suggest that the uptrend may be broken. Now, by the time the stock breaks the 50-day, you're likely going to see a number of other warning signs that have already occurred. But typically, this can be a very negative sign. So I would probably be exiting the remainder of my position on this sell signal. So let's take a look at an example. This is TravelZoo. This is going back about 10 years, a little over 10 years. And TravelZoo had a gigantic move. It started out at 10. I'm not sure if this stock had a split along the way, so I'm not sure about that. But it broke out around 10 and went up to nearly 111. So that's like an 11-fold move. So it's a gigantic move. But look at the 50-day moving average. That's a red line on your chart, and it contained the entire advance all the way to the top. So it held at the 50-day here on one occasion, 2, 3, 4, 5, 6 times. And then finally over here, kind of focus on that, right up here, you can see how weak the stock is on this day. You decisively closed below that line, and that's it. The stock is topped, and it went much, much lower from that point on. So if this was your only rule, that the only thing that you were really focusing on, you could have held the stock all the way up for a 10, 11-fold move, and finally you would be exiting the stock up here in the high 80s.
So Charles or Mike, how much would you be selling here?
I would be completely
out
of the stock
okay.
here. Yeah, this is a very ominous sign, given that the stock is held on 6 other occasions at the 50-day.
Yeah, and I totally agree with that, Chuck. But also, the fact that it had a base that broke out and was failing from there is, another sign that this stock is really, it's already had its day. And along with what Charles is going over, that break at the 50-day, combine both of those, there's no reason to be in that stock after that.
Yeah. And Bill would say, it's up 10 or 11 full. What more
do you want?
Yeah.
Right.
So let's move on to the next one. And this is when a stock has its largest one-day point loss since the very beginning of the move. And this is especially the case if that large one-day drop occurs on heavy volume, because that's going to suggest that institutions are behind the selling. Sometimes you'll see this large drop occur on a gap down, so it'll look, very, very worrisome or severe on a gap down. Now, we're not going to suggest that you sell your entire position simply because your stock has one really bad day. But at the very least, it should put you on guard and maybe put you on the defensive, because sometimes that first really bad day is just the beginning of a much larger decline. Let's take a look at what that might look like. This is Wesco International, and again, the lower left of your chart, you can see a cup with handle base. And the stock had a huge move, more than doubling over the next 7 or 8 months. And finally, just a few days off the top here, the stock has its largest one-day point drop of the entire move, going all the way back to the initial breakout down here. You can see the volume on that day was very heavy. In fact, go back up here, that's the heaviest volume since the stock broke out, the heaviest down volume. So that's your largest one-day point drop. You would begin to scale out here, because sometimes this kind of action just leads to a much further drop, which is exactly what happened. It got hardly any lift all the way down. And in fact, the next day after this large one-day drop, you had another bad day on a gap down. You did temporarily hold at the 50-day moving average, and then finally decisively break below it. So again, you're going to see a number of sell signals when the stock is putting in a top. Your goal is to scale out as you recognize these warning signs. Let's move on to the next one. This is when a stock has a downside reversal day. Now, a downside reversal occurs when the stock has a new intraday high, or is attempting to make a new high, but ends up reversing all of those gains and closes down for the day, closing near the bottom of the day's trading range. Now, often this occurs on a pickup in volume, but it's not always the case. So when we look at downside reversals, we're really focusing more on the price action. It does not have to be accompanied by heavy volume. Now, a downside reversal is not an uncommon occurrence. You will see sometimes many downside reversals in the context of a long move, long uptrend in a stock. And so it doesn't necessarily mean that an ultimate peak has been put in place, but what a downside reversal typically leads to is further weakness in the short term. So, that's very important information to have, because it's very important that you have an expectation of what is normal and what you can expect from your stocks. So if you see a downside reversal, you can prepare yourself for maybe another 2, 3, 4, 5 days of weakness where your stock may come in 10, 15, 20%. If you don't have an expectation that that's going to happen, then you might capitulate or get scared out of the stock right at its, when it's at its lows. So even if you decide that you're going to hold through this kind of action, at least you can psychologically, emotionally prepare yourself for what may be about to occur. So let's take a look at the downside reversal. This is a Novell. Again, stock broke out of a cup with handle base, staged a huge advance, more than doubled. Now, fairly early in the move, within the first 7, 8 weeks, you get this downside reversal right over here, and obviously that did not lead to the, was obviously not the ultimate peak, but you got what you would expect, about 5 or 6 days of further selling, and then the stock resumed its uptrend. So that's normal action, what you typically see after downside reversal. If we move to the closer to the top here and focus on that, you can see a downside reversal right here on this peak day. So you went into new high ground on an intraday basis, closed right at the bottom of the range. In this case, you did have a pickup in volume. Your expectation is that you're going to get further weakness from this point, at least for several days. Now, in this case, you only got one more day of weakness on an intraday basis, and the stock reversed back up, actually staged what we call an upside reversal. And our expectation after an upside reversal is that the stock will continue to move up, which is what happened over about a 2-week period. And then you can see right up here where my little pointer is, you get another downside reversal as the stock is attempting to get to new high ground. You close near the bottom of the range, and then you continue to fall from that point 1, 2, 3 more days down to the 50. You stage a relatively weak rebound rally over the next, 6 or 7 weeks. You can see that the volume really wasn't much to speak of as the stock was trying to rally back, and finally you roll over again. So that is your downside reversal. Let's move on to the last 2 technical sell signals that we're going to present today. And these are what we call churning and stalling action. And these are both forms of distribution. And in the past, I've always really used churning and stalling kind of interchangeably. But for purposes of this webinar, I'm going to differentiate between them. Churning is defined as heavy volume without further upside price progress. So you'll typically see this kind of action occur after a stock has already had a big move and is near new highs. And at these new highs, you'll see that volume will remain heavy, but the stock will struggle to move up further. Often you'll see the stock close in the lower part of the day's trading range. So what this churning action is suggesting is that the stock has already been played by the smart money, and at these elevated levels there's more than enough sellers to soak up demand from new buyers. So really, it's going to look like the stock is running in place with heavy volume occurring. Now, sometimes, another way we can describe churning is it's a process. You can identify churning on a single day, but you can also identify it over a number of days or even weeks, where the stock will be trading in a relatively tight range near its highs, and volume remain heavy during this process. Oftentimes, when you see this churning process, you see downside reversals occur, you see stalling days occur, and so forth. So that's what churning is, heavy volume without upside price progress. When I talk about stalling, I'm going to focus more on just the price action. It doesn't have to occur in heavy volume. The stalling would occur when a stock moves into new high ground, but closes well off the highs. So it's going to look like weak action, excuse me, like weak action on a daily basis, even if the volume wasn't that heavy. Let's take a look at what churning and stalling looks like. Now, this is a stock called GGB. It's a symbol. The stock broke out of this consolidation here. It's a little bit of a sloppy consolidation. It broke out and then consolidated again, forming, you might want to call it a flat base or a square box, kind of on top of this area here, and then finally staged the advance up here. Now, during this whole process up here, we're talking, say, 1, 2, 3, about 4 weeks, the stock is trading, very close to its highs, within a few percent of its highs. Volume is remaining quite heavy during most of that time period, and this whole process is what we call a churning process. You've got, enough sellers here to soak up demand from new buyers, so the stock can't make any progress, even though the volume is still heavy. You can see if we focus here on this little area, we get a downside reversal here at the peak. You come down, bounce up, attempt to go into new highs again, and again you get a downside reversal, which led to further selling for a few more days. You go up again and you hit a new high. And again you're turned away. So you're turned away a third time, a downside reversal, which led to further weakness. And finally, one last attempt at these new highs around the 26 range. And you can just see that over 4 weeks, the stock cannot get through 26. It just keeps getting turned away. Finally, you get this stalling action here. You go into new high ground but close well off the highs, mid-range, and then finally the stock reverses and just falls. You fall out of this churning range here and ultimately fail at the 50-day moving average and continue to just move down from that point. So if you see this kind of churning action occur where your stock just isn't going anywhere, I have a saying, I don't like to sit in a stock waiting for something to happen. I would rather scale out of my position as I see is having trouble in this range. And I can always buy the stock back again if it consolidates and breaks out. But I'd rather scale out and wait and see what happens than just sit in the stock when potentially it can fall apart relatively quickly. So these are the 7 signals we're going to cover today. Now what we are going to do is go through a couple of stock animations. I'm going to bring Mike and Amy back into the discussion. And what we're going to do is go through 2 topping processes on 2 different stocks. And Mike and I will talk about how we would scale out of the position as we see the warning signs. Mike, you want to take us?
Sure. Let's start with the first one. And just, as you're watching this, just imagine you have a position that you bought out of that double bottom. You probably started purchasing right at the pivot around 31 bucks, and then maybe you pyramided into it a little bit. So pretend your cost basis is maybe $33, $34, and we're looking for some sell signals. And the concept here is not sell everything on one day unless you're forced to with a massive gap down, but we're going to be looking for sell signals and try to scale out. And let's just imagine that you have 1,000 shares, and let's walk through this and see when we'd be selling those shares.
All right. Okay, so the first signal we see here, and we're going to identify each of the warning signs that we're going to come across, is a day in which the stock goes into new high ground. You don't really have a heavy volume here, and you're closing well off the high. So this is characteristic of stalling action. You can even say it's going to new high ground on low volume. So it's almost, it counts as 2 signals in a sense. But we're going to basically identify that as stalling action, again, because of the weak price action.
Right, so now we're moving up a few more days and we get similar action. So a lot of times with these offensive sell signals, you're not necessarily going to act on the very first one or sometimes not even the second one, but you do want to be nimble and flexible. And one of the things that Bill's taught us over the years is that sometimes just sell a little bit just to make sure you're not going to freeze up. So sometimes you might just sell 5 or 10%. So here we have 2 days of stalling. We have a good gain in that. Remember, our cost basis is around 33 bucks, so we're up 10 bucks on it. So maybe you sell 100 shares here, and then we'll look for some more sell signals before we sell some more. You don't want to get crazy and sell everything here.
Right. And Bill has said in the past, it's always preferable to sell when you've got a market to sell into. You don't always want to sell when things get really ugly.
When you have to.
Exactly. Right. So, I like personally to sell into strength. So, you see these kind of, weak days moving into new highs. You can sell a little bit into it, as Mike mentioned. Let's continue and see what happens. And the very next day, we get another day where we are, basically at new highs. Now, look at the volume this time. Volume is above average. Now, it's not super heavy. It's only 13% above average, but it is above average. You are kind of, running in place here. So that would be identified as churning action. So you can basically what's happening is your stock is coming under some distribution. Let's continue.
All right. So now that at first glance that day does not look too bad, you're trying to go over some area of small area of resistance, and it's closing near the highs. So the price action isn't bad, but if you go down to that volume area, you can see that there's really no volume there to speak of. So that's new highs on low volume. That's your forced sell signal. So you want to ask yourself, how many shares would you have sold by now? And maybe you sold 20, 30% of your position by now. About how much would you have sold, Chuck?
Yeah, I agree, Mike. Maybe if we started with 1,000 shares, maybe I've sold 250 shares or so. And the beauty is the stock is at new highs. I mean, you're within 1% or so, or even closer to your, to the peak of the stock. So, we're taking advantage of this strength basically to scale out. Let's see what happens. There was your new highs on low volume. All right, so the stock 2 days later again goes into new high ground here and closes in a weak fashion. So again, you see a pickup in volume. It's not super heavy, but it's above average. You go into new high ground, close well off the high. So again, the stock really hasn't gone anywhere over the past week, right? So this is a churning day here, churning action. And again, we've had 5 sell signals, and again, the stock is basically within 1% or 2 of its highs. Let's continue.
All right, so now we get into new high ground, we get turned away, and we close at the low. So that was a downside reversal that Charles was talking about earlier. So it's now we have 6 reasons to sell. So some of you might be looking at this and saying, maybe you haven't sold any yet, but once you get 6 sell signals, you need to do something. And so again, just ask yourself, how many shares would you have sold? And I probably, still just be around 30% or so. I tend to, not do as good of a job as Charles does as selling into strength. So, how much would you have sold by now?
I mean, maybe by this point, I'd be with you, maybe, 30 to 35% of my position. I mean, again, the stock hasn't shown really any weakness. It's really just more kind of offensive selling, some distribution here. The stock hasn't even had a pullback to the 50-day yet. So oftentimes the big winner will at least have one pullback to the 50 days. So, when you see this kind of action, this downside reversal, the expectation is that it's going to come in at that point. So, an obvious area for it to come into would be the 50-day moving average down here around 40. So you have to ask yourself, are you prepared to see your stock, fall, what is that, 6 points or so? So that would be about 15 or so, 16% off its highs, because that can happen at any time, and it would still be normal for the stock in the context of the uptrend. So let's see what happens.
That's freaking ugly. So, lots of times we end up in a situation like this where, maybe you haven't done any selling yet, and then you get hit with a huge day like this. What I would suggest in a case like that is I'd like to kind of slow down before I take action, print off the chart, and kind of mark up the different sell signals that were there. And so, I've been in this situation before, and so you mark them up, and before you know it, you realize you have 7 sell signals, and maybe you didn't do anything. So on this day, that stock is not acting right. It has its largest one-day point loss. So if you haven't sold any, you're going to sell a lot. If you've already sold some, you're in a little bit of a better position. And then you just have to ask yourself, is this a stock that you want to sit through a base on or not? And that really becomes more of a fundamental question. But here the stock is not acting right and needs to put in some time. So I would at least have sold more than half my position. So I'd probably be down to about 30% of my original position by the end of this day. What about you?
Yeah, Charles, how much are you in right now?
Yeah, so, I guess I'm not as convinced that, it's going to now form a base. The stock is still held at the 50-day moving average. It closed well off the lows here. It can certainly